Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a mediator and business valuation expert in St. Louis, Missouri. Today, we'll be talking with Kelly Finnell. He is based in Memphis, Tennessee, and is one of the nation's best ESOP consultants, having spent more than 40 years helping business owners design and execute employee stock ownership plans. Kelly is also the owner of a preeminent ESOP book, the ESOP Coach, using ESOPs in ownership succession planning in 2010, and his work remains the most comprehensive guide to ESOPs today. Welcome, Kelly. How are you? They also offer these tax advantages compared to the other benefit plans and ownership structures. Is that what you're talking about? Like that there would be no tax? Like, this is fascinating to me. This is a huge perk, right?
Well, and one of the things that you said triggered a thought in my mind. When people ask me what are the biggest problems with ESOPs,
Yeah.
my first answer always is lack of knowledge.
Yeah.
ESOPs are a subspecialty within a subspecialty.
Okay.
So ERISA is a subspecialty of the tax law and the benefits law. And then ESOPs are a subspecialty of ERISA.
Okay.
So I have clients tell me all the time, I asked my lawyer or my CPA about whether I should consider an ESOP, and they said, I don't know anything about ESOPs.
Right.
And so that's the biggest problem with ESOPs is lack of knowledge. And so I consider myself, in addition to being an ESOP consultant, an ESOP evangelist, spreading the word about all of these great benefits.
Yeah. Yeah. No, I mean, but did I hear you right? And were you saying that, so if I become an ESOP owner, I'm not going to have to pay taxes on that either?
Right. So let me give you a comparison that will help this come to life a little bit.
Okay.
At the end of every year, for participants in 401k plans, they get from their non-401k investments a 1099, telling them what the taxable gain was on their investment accounts.
Okay.
In their 401k plan, they don't get a 1099.
Right.
And they've never asked themselves why. They just know that that's the rule. The reason they don't get one is they don't own those assets. Those 401k assets are owned for their benefit by the 401k trustee, which is tax exempt. So 401k is a qualified plan, ESOP's a qualified plan. So we've got this tax exempt trustee. And when we flow income through to that tax exempt trustee, obviously there's no tax because the trustee doesn't pay tax. And so we end up in a situation where a business owner can operate their company as if it were a church or a synagogue.
Wow.
No tax on their income. And so think about what that does. If I'm saving that 40% tax, then I can pay back a 5-year bank loan in 3 years because I've got so much more cash flow.
Right.
I've got 40% more cash flow than I had without the ESOP. And so the practical benefits of this tax structure are incredibly powerful, and business owners don't know about it.
Well, and essentially what you're saying is, like, upon retirement or sale, if you are bought out of the ESOP, you would then maybe see the gain or the payment of taxes at that time.
Yes, the ESOP participants are going to pay the tax.
Okay.
And so the tax is still going to be due, but the tax has been shifted.
Correct.
So the owner didn't pay tax on their sales proceeds. Then the company didn't pay tax for, let's say, 20 years. And so now we've got an employee who's been in the plan for 20 years. The employee is going to take a distribution of their account. Now they're retired. They're going to roll that distribution over to an IRA. So no tax when they do that. And then they're going to take a portion of that money out each year over the next 20 years to support their retirement income.
Mm-hmm.
So the tax has been shifted from the company to the people who are benefiting from the ESOP,
Mm-hmm.
which are the company's participants.
And